All right. Good afternoon, everybody. How you doing? You are here with Mike Shorr. I am filling in for my good friend and our CEO, Scott Bauer, today. How's everybody doing? Just let me know that you can see. If you can see and hear me, that'd be awesome. Just give me a quick yes. Hey, Darby, how you doing? All right. Well, let's get right into it. Yes. All right. Now, if you can, please like, subscribe, smash that button. That helps us out a lot. Lets us know that you like what you are seeing here. Okay. What are we going to talk about today? We're going to talk about expected move. Thank you, David. Thank you for smashing that thing. All right. So the expected move, this is the estimated dollar move of the underlying price for a given expiration, an options expiration date with a 60% certainty. Let's talk about this. I'm going to pull in something like this. So does everybody know what a normal Gaussian curve looks like, right? Excuse my drawing. Normal Gaussian curve, with this being the mean, I guess that would be equal to the price of the underlying. I want to make sure that everybody can see that. All right. I know that I'm just pulling in a random document here. Okay, and what we are looking at here is that given a normal bell curve, Gaussian curve, whatever you want to call it, a standard deviation move, this would be -1 SD. Again, excuse my drawing here. I'm drawing with my mouse. +1 to a -1 SD. That is going to encapsulate the move approximately. The calculus doesn't work out perfectly, but about 68% of the time. So that means that we are going to move up or down 68% of whatever the standard deviation move is over the course of time. A 2 standard deviation move. Let me clear this out because that is darn messy. So we know that I'll just say ±1 standard deviation move. That's going to equate to about 68% of the time. Or you can think about it as a 68% confidence that it's going to stay between that plus and minus 2 SD. 2 SD, again, apologizing for my mouse drawing here, that's going to encapsulate about 95% of the move. And a 3 SD, that's going to encapsulate about 99%. About. Like I said, the math doesn't work out perfectly. Let's get that out of the way. And let me clear that out. Whoop. I hit something that I didn't want to hit. There we go. I tried to hit erase. There we go. So the expected move for the formula you use at the money options. It's the most accurate estimation for the actual expected move. So this is not something that somebody is saying just because you heard it. Maybe they said it on TV. Maybe you said it on, maybe you read it on something. Well, this person, let's just say I'm me and I'm writing something. I say that, well, I think that the SPY can go to X or minus X over the course of time. That's nice that I think so, but it's really based on nothing other than me saying so. The at the money options and the implied volatility that's derived from that at the money options, that's real money at stake. People have said, I want to buy it here, I want to sell it here. The market comes together, price discovery. And from that, we can say, okay, people that are actual market participants and not just saying something, this is what they think the move is going to be. So like I said before, the option prices, they're the drivers of the expected move. And when implied volatility changes, well, then the expected move goes with that. When implied volatility goes up, the expected move is higher. When implied volatility moves down, the expected move is lower, and that is reflected in the option prices, which then we can put into our options formula and derive what we want to, what we think that what the market expects that market to move in a given time frame, right? We need three pieces of information. We need the underlying price, we need the implied volatility, and we need the timed expiration. Those three things, we can calculate it. A very quick and relatively accurate way to do this, and maybe I'm getting ahead of myself, but like we said here, the platform updates the expected move using live data in real time. Now, how can this help us? Well, actually, let's go back. Let me pull this off for just a second here. All right, and let's say that we are looking at something like NVIDIA. NVIDIA's trading approximately 137 bucks right now. I'm sorry if this is a little bit small. I'll make it as big as I can. So if we were looking at, let's just say for Friday's expiration, the 137 calls, we're looking at, let's just say 185 and 190. So we're looking at, and we can, so if we just look at the call and the put for the straddle, 185 plus 190, if I can type. So they're looking at a $3.75 move between now and Friday. And what does that mean? That means approximately 68% of the time we should be plus or minus $3.75 from what I called the 137 line at that point. Does that make sense to everybody? Just want to make sure that you guys are with me. That's a quick back of the envelope. Now, of course, we're not trading exactly 137. We're trading 136.61. And so we can actually calculate this with the implied volatility. We're looking at a 46 half vol here. Let me pull this back in here. There we go. And also, let me make this smaller. We can also look at this. I have a spreadsheet up here. We said that implied vol was 46.5%. The implied we were trading somewhere in the neighborhood of, I'll just keep it with 137. And you can see that we're looking at actually it's a little bit different because our prices were a little bit off, but we're looking at, a full standard deviation move of about 3.45%. Does this tell us anything about the direction? Does a move tell us from the expected move? Does that tell us anything about direction? No, you're right. David and Gus, you're right. Right. It says what the magnitude of the expected move is. It doesn't say a higher implied volatility necessarily means bearish, or a lower implied volatility necessarily means bullish. Now, we do know that implied volatility in the markets for equity markets, as things go up, implied volatility tends to come down. And as things go down, implied volatility tends to go up. But that has nothing to do with the math. It's just strictly what is expected one way or the other. Okay, so now how do we use this? So we can use it for position sizing based on potential price swings. It also can give us an idea of setting appropriate stop loss levels. If we are long something and we move more than one standard deviation away from where we were, not a bad idea to pull the trigger and get out. And also, in a big reason and a big way that we imply this or use this, not imply it, that we use this implied output is determining option strike prices for strategies. For example, if we are looking at a vertical spread, either a call spread or a put spread, well, we're asking a little bit much of the market to give us more than a standard deviation move. If we get more than that, we get more than that. But it gives us a reasonable level to target certain prices, because guess what? We're not the only ones looking at this. Every trader that's worth anything is looking at standard deviation moves. And so when we get outside of that, kind of your calculus changes here. It can also help with the strategy selection. We can look at whether option premiums are expensive or cheap. If we have very expensive out of the money calls or puts outside of the expected move, well, then that should give us some pause. Why are they willing to pay more for calls or more for puts, or less for calls and less for puts? And then it can also help us choosing between directional and non-directional trades. If implied volatility is high, do we really want to buy Vega at those levels? Not really. So we might be looking at a non-directional trade, such as an iron condor or something like that. Because, in relative terms, implied volatility is high. It's really going to have to move a lot more than what is normal for us to get hurt on something like that. And then that also helps us assess a risk-reward ratio potential for those trades. Now, the misconceptions and the pitfalls of this, remember, implied moves, they are estimate. They're not rules. This is just given what the market is willing to pay or sell, not or, because somebody's got to buy what you're selling and sell what you're buying. But they are estimates. So I wish I could say that here's the rule for trading. You always do this or you always do that. Doesn't work that way. But we live in the world as traders, and as human beings, we live in the world of probabilities, not possibilities. Yes, Nvidia can go to 10,000. It can go to zero. Statistically, neither of those things are going to happen. And so we have to use the best estimates that are available to us. And this is a great tool for that. And then historical moves may differ significantly from the implied move. Remember that, Nvidia was a lot more volatile, let's just say 18 months, 2 years ago. It was going from, what would be considered now a very, very low level to pretty stratospheric. That doesn't mean, Nvidia has matured. Buyers and sellers have a much better idea of what's going on with this type of company. Now, what's going to happen in the future? Well, that's all for the traders to figure out. But historically, looking back at what's happened is not necessarily indicative of what the future holds for us. And that's why we rely on the implied volatility. And then a lot of times you have to remember that, I believe Scott talked about this yesterday, the volatility crush that happens. If we don't get a move that is close or whatever, statistically close to that move that was priced in, implied volatility is going to absolutely come in. You can count on your, well, I don't have the exact figures in front of me, but basically on 10 of your fingers, you can count major companies that implied volatility has not come down after earnings, something like earnings or an event, FOMC, but mostly like earnings. So the volatility crush, that can impact option positions because we know it's going to come down. Everybody who sold options is worried that we're going to get a bigger move than what happened. Those that bought it are hoping for a larger move than what happened. But if we don't get something out of the ordinary, implied volatility is going to mean regress. Hopefully that makes sense. And like we said, we're going to smash that button. And 68, that's it's not, like I said, it's not exactly 68%, but it's approximately 68%. But the word of the day, nope, that's not the word of the day. The word of the day, Mike, is going to be math, right? I think he's going to post that here. Word of the day is math. That's going to get you on the wheel. All right, let me get rid of this here. So does anybody have a stock that they've been looking at while we have everybody come in here? And we can actually look at what in snow. All right, let me make sure. I want to make sure of one thing is snow. So snow has earnings after the close today, right? Do we expect implied volatility to be low or high? On a relative scale? We have earnings today after the close. David's right? Implied volatility should be high. And if we look at this here, if we look at snow, excuse me, bring up snow. All right, we see that implied volatility for Friday is 168.5% using rough numbers. If we go out in time, we see really we're looking at something that usually trades in the mid 40s, mid to high 40s. Yet for Friday, they're pricing in 168.6%. Earnings are coming up, and people don't know what the heck is going to happen. But they're willing to pay for that gamma in these short-term options. Look at these options are going out in 2.5 days. And for something that's trading 182 half, 181 half, we only have $2.50 wide here. But we're talking about at the money options there in the 8.5 range. So if we use where'd my calculator go? So and right now we're in between strikes here. But what are we closest to? We're closer to 180. So if we look at the 180 strike, we're looking at a strike price on the call of $9.65, and on the puts, $8 and I'll just say 30 cents. So we're looking at, like, if we're using that method, we're looking about an $18 move. If we divide that by the price, 180, 120, they're looking for about a 10% move if we use that back of the envelope calculation. Now, if we do the more rigorous one, we know that the price of the underlying is 181.20. And we're looking at 523. And what did I say? 168 something? Let's just make it 169. So they're looking at, on a full standard deviation move, the at the money straddle most closely is going to be more towards a 50. It's not exact. I don't want to get all mathy on you, but it's almost a 50% confidence interval. That full standard deviation move, they're looking at about a 12.5%. So 68% of the time, give or take, we should be, let's just call it $23 above and below where we are right now. And I don't know what happened here. I've been busy with you guys, but the market's just tanked on something. I'll find out in a couple minutes. But down. So they're pricing in, about a 12.5% move. And we can use that to set up different, if we were looking at a call spread, we would be wanting to target, somewhere around the 202 half, 205 strike. If we were looking at a put spread somewhere in between, the 157 half, 160. This gives you logical targets, not just guessing. I think it can go to 400. I think it can go to 50. This is using actual math, and the math derives from the prices that are traded in the market. Okay, remember the word of the day is not 68. The word of the day is math. I just don't want anybody to get kicked out of here. And like I said, any trader who's worth anything, they're looking at these standard deviation moves. They're targeting the same places. They're looking to sell gamma or gamma derived deltas above the 2SD. They're looking to buy it below the 2SD. You get outside of that, well, I mean, that's why the market is the market. All right, Mike, do we want to spin here? And is there any, and well, first, before we do that, we'll get that all set up. Are there any questions? I know we went through a lot of stuff quickly. Oh, the wheel's closed. But what questions do you have while the wheel is getting ready? Probably what that move down was that 20-year auction. By the way, I looks like the 20-year auction did not go well. Like I said, I'm live with you guys right now, but that seems to be the driver. That means that bidders for U.S. Treasury are pulling back, meaning that they want more yield than what it was before. So that takes Treasuries down. What is Market Minds? You're in it. So when treasuries themselves go down, that brings the implied yield higher. All right, let's get this wheel going here. 1 second. A lot of names on here. Thank you, thank you, thank you. Let me get. What kind of situations would you go for a 2SD? When you're swinging for the fences, which is never for me. All right, here we go. Who? It's a David, but David Roberts. David Roberts is our big winner today. All right, man. That Treasury 20-year note auction did not go well. Like I said, I have to catch up on that. All right, so David, email your shirt size and your address. prosperswag@prospertrading.com. Well, we do this every day, Paul. So try again tomorrow. All right. Did I catch everybody's questions before we get back to trading? I really appreciate everybody coming by today. Always a pleasure. Well, thank you very much. And then we will get back to this as soon as, we'll see you tomorrow. All right, so everybody, thank you. Any questions, you can always email me at mshorr, that's MSHORR, at Prosper Trading. And I will do my best to answer any questions that you have. All right, thank you. And I'll see you in STO shortly after I get set up again. And if not, I will see you next time when I'm here for Market Minds. All right, thank you so much, everybody. I really appreciate you coming by.